Now, let's kind of see how a mortgage note payable actually works in terms of the payments and accounting for the interest and the partial principal payments with a fully amortizing mortgage. Here's a different loan, and let's look at the terms of this and see if we can do the accounting for this mortgage note payable. Assume that on April 1st in the year X7, real estate is purchased for $300,000. This is a land and building. The land is valued at $50,000 and the building is valued at $250,000 respectively. The purchase price is paid in cash, $30,000, and through the execution of a mortgage note payable of $270,000. So we're paying for the $300,000 price tag of this real estate by using $30,000 of our own cash and effectively borrowing $270,000 to complete the transaction. The journal entry to record the purchase of this real estate would be to debit land for $50,000, debit building for $250,000, credit cash for $30,000, and credit mortgage note payable. Now, the reason why we're going to debit both land and building separately rather than combine and just call it real estate is because land is not depreciable, but buildings are. And so we must distinguish these two assets because the amount of capitalized cost of the building will have to be depreciated on our books, as we discussed in the previous lesson 8. And we need to know the amount of that depreciation. Now, let's assume that the $270,000 mortgage note payable is a fully amortizing mortgage over 30 years. That means that with each payment, not only are we going to be paying interest, but we're also going to be paying a portion of the principal, such that after the 30 years, with a payment every month over those 30 years, we will have paid off all of the debt of $270,000. This note also bears interest at 9% annual interest, compounded monthly. I'll explain that in just a second. With monthly payments of $2,172.48, payable on the first of each month, beginning the first month after the date of purchase. Since we purchased this on April 1st, the first payment will be due on May 1st. Now let me explain that this monthly payment amount of $2,172.48 includes a monthly amount of interest that's due and a portion of principal payoff. How the heck did we come up with that number anyways? Well, if you have a very simple, basic financial calculator, you can make this calculation by simply inputting the amount of the principal of the note, $270,000, the amount of the annual interest rate, and the term of the note, which is 360 months in this particular case. And then that calculator will spit out $2,172.48. Any decent real estate agent will know how to use one of those. You know, you're out there shopping for a house and they say, hey, that's a beautiful house over there. And many times you're not even concerned about, you know, what the price of the house is. It's gee, what is my monthly payment going to be if I buy that house? And the real estate agent will pull out their little calculator and figure out the amount of the mortgage and calculate this monthly payment. It's a very simple thing given a calculator. However, I want you to understand really the theory and the mathematics behind this calculation, but that won't be presented until a more advanced course. We're going to stay with the most basic calculations here and just assume that this number is going to be given to us. The fact of the matter is over the internet, at any bank site or anything like that, financial institution, you could probably access a simple amortization schedule for a mortgage and figure out by simply inputting the data exactly what your monthly payment would be. Okay. This compounding interest, it says 9% annual interest, compounding monthly. What that means is this. If you fail to make your monthly payment on a timely basis, the next month's amount of interest will be not only the amount of interest based on the outstanding principal, but also on any unpaid previous interest. So that if in fact you fail to make a payment, you're going to be paying not only interest on principal, but interest on interest. That refers to the compounding effect of interest. But as long as you make your monthly payment on a timely basis, this compounding effect, which will result in more interest cost, really doesn't come into effect. All right, now, let's take this information now that's been given to us and actually make an entry to reflect the true economics of what's happening on the date of the very first payment here, May the 1st in X7. And again, we'll assume that we're making the payment on a timely basis. If that's true, we're going to credit cash for $2,172.48. And frankly, we're going to make that credit to cash every single month because we have this mortgage payment that has to be paid like clockwork every month. So we credit cash because we cut a check to the bank on the mortgage. The debits will be to one of two accounts. You're going to have a debit to interest expense. The amount of this interest expense will be calculated based on the interest rate times the principal of the amount of the loan. At this moment, it's $270,000. And the interest cost is for the 1 month that has expired. I mean, we borrowed this money on April 1st. We're making a first payment on May 1st. And so effectively, every month as we make the payment on this mortgage, we're going to be paying that month's interest. Well, that's easily calculated. It's 9% is the annual rate times $270,000. The principal amount due for 1 month or 1/12 of a year is $2,025. That's the debit to interest expense. You immediately recognize that there's a difference between the amount of cash paid and the cost of interest for that 1 month period. As we noted previously, one of the most common characteristics of a mortgage note is that it will be written in a way that it provides that to the extent that you make any payment at any point in time, in excess of the amount of interest that is due, the excess is applied to the principal of the note. So what we're really doing here is we're paying off a little bit of the $270,000 that is owed. And we'll debit the mortgage note payable for $147.80, that excess that was paid at this point in time. As a result of this, you can see that the amount of the balance of the mortgage note payable is actually decreased. After the first payment, we no longer owe a principal amount of $270,000 because there's been a partial payoff of $147.80. At the beginning of the second month of this mortgage note, the balance of the principal is $269,852.20. Well, let's take this another step further. Let's go ahead and do the accounting for the second payment. This is on June 1st, the very next month. At this point in time, again, we're going to credit cash for $2,172.48 because that's the amount of the monthly payment. And it will be the amount of the monthly payment under a fixed rate loan every month for the next 30 years. The debit is to interest expense for the cost of interest, the cost of this borrowing at 9% for 1 month, which is $2,023.89. How did I come up with that number? Well, it's 9% times the principal balance. But here's where students sometimes get, well, they make a kind of a dumb mistake. The principal balance after the first payment is no longer $270,000. The amount of interest will be calculated based upon a declining amount of principal, because with every month we're paying a little bit off. And since interest is calculated based upon the principal balance outstanding, how much we actually still owe, the 9% should be applied to $269,852.20, which is the principal balance after the first partial payoff. This interest will be for 1 month, 1/12 of the year, and the balance is the amount is $2,023.89. That's the amount of interest for the second month. The excess of the cash payment, our monthly payment, over the amount of interest cost for that month is now $148.59, just looking at the difference there. Now let me ask you a question. If right now, after the second payment, the business wins the lottery or something, or comes into some additional cash and says, hey, listen, we don't need to be, why don't we just pay off that mortgage and get rid of the interest cost at 9%? That's kind of a high interest rate or something like that. If they did, how much would they actually, immediately following the second payment, how much would they actually have to pay the bank to completely pay off the mortgage note? Well, it wouldn't be $270,000, even though that's how much we borrowed originally, because with each payment, we've actually paid off a portion of that mortgage note payable. In fact, if we were to look at a general ledger T account, we know that the mortgage note payable was originally a credit for $270,000. But with each payment, there's been a partial or a small portion of payoff of the mortgage note. The first payoff was $147.80, and the second one with the second payment, $148.59, such that the running balance of the mortgage note payable is $269,703.61. That's how much is owed at that point in time. Let's take a look at what would be a mortgage amortization schedule for this particular loan. A mortgage amortization schedule is in fact a listing of the payments every month, and there are going to be 360 different monthly payments, all an equal amount of $2,172.48. And it will show us with each of those payments how much of that represents a payment of interest and how much represents a payment of principal. By the way, maybe I should, when I see this word amortization schedule here, some of you are probably thinking, hey, wait a second, Norm, back in lesson 8, you told us that the term amortization is a term used to show the allocation of cost of an intangible asset over its useful life. Well, you're right. And frankly, this is just a different utilization of this term. There are some common characteristics. Amortization of an intangible is resulting in the reduction of the cost of the intangible as we allocate it to expense over time. What we're talking about here is the reduction of the principal of the note as we make monthly payments. So maybe there's some correlation in the terminology here, in that amortization means a reduction of or using up over time. But frankly, they're very different. And so you should be aware of the different utilizations of this term amortization. In this case, a fully amortizing mortgage is really talking about the full payoff of the principal balance over the life of the note through the monthly payments. Now again, if you look at this amortization schedule, and again, these numbers will coincide with our original 2 entries, because in the first month we made a payment at the end of the first month of $2,172.48, and the portion of that representing interest we calculated at $2,025. The excess was $147.80. And again, in the next month, you see we made exactly the same amount of payment, but at this point in time now the principal balance has been reduced by that partial payment in the first month. As a result of that, the amount of the interest cost is a little bit less. It's a little over $1 less than it was the previous month. That's because the amount of interest applied to the principal, because the principal balance is actually reducing or declining, the amount of interest is fractionally lower in that second payment. And as a result, the amount of the principal payoff has actually increased a little bit over the amount of the principal payment in the first month. And you can see that that pattern kind of continues. The amount of the interest portion of a payment gets a little bit lower and lower and lower as you look through the first 8 payments, and the amount applied to principal is increasing a little bit. Again, because we have a common amount of the payment, and whatever is applied to interest, any excess is applied to principal, and so as the interest portion reduces, the principal application is increasing. But it isn't increasing that much. However, When you get down to pay to month number 358, I'm sure you'll be kind of stunned to see that over time, the principal reduction with these payments over 29 years, that the amount of the principal balance has now been reduced from an original amount of $270,000 to only a balance of $6,420.86. That seems almost unbelievable how significantly it's been reduced, given the fact that we were really applying small amounts to the reduction of principal. But as time passes, this change becomes more significant. Look at this payment in month number 358. The amount of the payment is $2,172.48, the same amount, but notice that the amount of interest is very low. Because 9% interest on a balance at that moment of only $6,420 means that the amount of interest for 1 month is not much. You can see that in these last years of the mortgage, that most of the monthly payment is being applied to the principal balance. In fact, if we look at the very last payment, the principal balance outstanding is $2,156.28, and of the full amount paid, the monthly payment of $2,172, there's only about $16 of interest, and all the rest finally completes the payoff of the mortgage note. If we then went to the principal portion column and simply added up the amount of principal payments made and applied to the principal, for all 360 months, it will equal $270,000. That's how much we borrowed. That's how much we must have paid over the 30-year period in terms of principal. Notice the staggering amount of interest that was paid. I mean, here you thought you were buying some real estate for, what was the original amount? $300,000, and you borrowed $270,000 to do it. And you paid over $500,000 of interest, basically to finance that purchase of that real estate over a 30-year period. Now, let me talk a little bit more about real estate and maybe even real estate investments. I always have students that come to me. And because I've been involved in some real estate transactions in my past life, in fact, as I've mentioned before, was involved in a real estate investment business, they think, hey, Norm knows real estate, so let's go in and talk real estate. And a lot of times they'll come in and they'll say, they ask me, Norm, don't you think I ought to go out and, instead of renting an apartment here on campus, shouldn't I go out and, buy a condominium? Wouldn't that be a better investment or utilization of my money? I mean, heck, every month I pay this rent, and it's like money going down some rat hole. Why should I rent when I could be building some equity in real estate, is what they'll say. Well, let me ask you a question. How do you really build equity in real estate? I'd like to take a few minutes and discuss that. I think you'll probably find this pretty interesting. In this context, I'm going to define equity as the amount of cash left to the owner in the event of the sale of the property. So to build equity means that if we sell it, I'm going to get, how much cash will I get? And that'll be certainly after the payoff of any liabilities. And how can we build this cash that we would get in the event of a future sale? Well, let's go ahead and look at this problem that we've kind of been using as an example and assume that we're going to purchase some property. Maybe it's a home or something like that. It's a nice home, or whatever, depending upon where the area is. We're going to, buy real estate for $300,000. We put $30,000 of our own cash down, borrowing the remaining $270,000 to complete the purchase, and executing a mortgage note payable for that $270,000. Now, at that moment, I would probably say that you as the owner have $30,000 of equity in the property. It's how much cash you have in the property. So now let's kind of move forward. Let me ask you this. What would be the proceeds, if in fact, of cash, if you now sold that property, let's say 2 months later? So you buy it for $300,000, and now you sell it 2 months later for $300,000 cash. If that were to happen, and assuming you got the full $300,000, and I'm going to assume that there are no selling costs. Now that's an inappropriate assumption, because whenever you sell real estate, there are some costs associated with selling that real estate, commissions and closing costs and escrow fees and various other possible costs. So this is probably an unrealistic example here, but we'll use it just to make a few points, and then we will go through an example where we actually apply some of those closing costs to see the effect of them. If in fact 2 months after I buy this real estate for $300,000, I sell it to somebody else for the same amount of $300,000 without any selling costs. Because I've made 2 payments on the mortgage note, assuming I have done that, the payoff of the mortgage note at that point in time, taking the $300,000 of cash I received from selling the property, I would have to take $269,704 of that cash to pay off the mortgage note that was originally $270,000. That would leave cash in my pocket of $30,296. What was the buildup of my equity over 2 months of ownership? Well, the buildup here over 2 months of ownership was a not very significant $296. Effectively, I'm just getting $296 back from the monthly payments that I made over the first 2 months. When you really think about it, when you make your mortgage payments, especially in the early months of a mortgage, almost all of that mortgage payment represents payment of interest. Very little of that actually represents payments of principal that build your equity in the property, where it's really your money into the property. What I'll say to a student sometimes is maybe if you pay rent, you may have some money going down a rat hole. But if you enter into a mortgage to buy real estate, and now you're making mortgage payments, most of that's going down a rat hole too. because most of that represents interest that really isn't building any equity. A small portion represents payment of principal, and yes, that comes back to you in cash when you sell it, but the interest is gone forever. I mean, it doesn't come back to you. So how do you really build equity in a real estate if you're not really doing it in a significant way through the monthly payment? Most of the buildup in equity on real estate comes from appreciation in the value of the real estate over time. Let's kind of continue and play this out a little bit. Let's assume that the property is sold after 1 year and that in fact the value of the property has increased by about 10%. Well, a 10% increase on $300,000 would be a $30,000 increase. So let's assume that in fact the property has appreciated through inflation or whatever by $30,000 such that now we can sell it for $330,000. If we did that, in most cases you are going to be bound for some selling costs. And frankly, the selling costs typically average about 7%. I mean, the standard brokerage fee for real estate agents is 6% on a sale of property. And other closing costs might amount to another 1%. So it is not unusual for about 7% of the selling price to actually go out as a selling cost. That's a big number. Many times students and other people think, well, I'm going to sell it myself. I'm not going to use a broker. But my own personal observation has been that when in fact you try to sell it yourself, the person who now is bidding and trying to buy the property recognizes that there's a broker not involved and knows that it can be bought more cheaply than if a broker had been involved. They want that $23,000 in terms of a lower price. And so in most cases, this selling cost either is actually paid or does get eaten up in terms of negotiations with a buyer who's trying to get that savings for themselves. In any case, let's assume that you do try to sell it on your own. You can't find anybody. You finally decide, well, I'm going to have to basically engage a real estate agent and pay the 6%. And so you go ahead and you do it. In this particular case, your actual net proceeds from the sale, after paying the selling cost, would amount to only $306,900. Now, after a year of making monthly payments on your mortgage, the payoff amount of the mortgage note payable is now down to $268,155. I've done those calculations for you. After we pay off the mortgage note, we will have in our pocket leftover cash of $38,745. What has been the buildup in equity over the last year? Well, the buildup in equity has been $8,745 because we originally put in $30,000, and now we've got $38,745, so the buildup in equity has been $8,745. What has actually caused that $8,745 increase in the equity? Well, the cause of that was appreciation to the tune of $6,900. The fact that we were able to sell it net of the selling costs for $306,900, which was more than we'd originally paid of $300,000 by $6,900, explains part of it. The other explanation of the buildup in equity was because we had been paying off a portion of the note through our monthly payment. That amount of payoff had been $1,845, which explains the total buildup in equity. And that's my point. When in fact you purchase real estate to build equity, you're making an investment. You build equity one of two ways. You build equity to the extent that you're paying principal with the monthly payment, but really that is not very significant. The major source of equity buildup is through appreciation. And the fact of the matter is that for you to get your even a small increase or buildup in equity, that property is probably going to have to certainly appreciate by more than 7%. Because you're going to have probably selling costs equal to 7%. So, a student who's thinking about maybe buying a condominium while they're going to school for a couple of years had better think long and hard about whether they really truly believe that there's a lot of upside in appreciation of values in the marketplace. Because if real estate values are stable over a few years, well, you're not going to have any equity buildup. And in fact, if you have to pay selling costs just to get rid of it when you graduate, you may actually incur a loss if there has been no appreciation over time. So again, just so that you recognize that when you buy real estate, you got money going down a rat hole as a result of interest costs. Now, you may recover your principal payments, that portion of the payment that represents principal, but usually only if the property appreciates, if in fact you're going to have somebody help you in selling the property.